Okay, welcome everyone. Just going to give it a second while everyone jumps on. Okay, well let's go ahead and get started. Good afternoon and welcome to today's webinar on the forecast for the winter real estate market. My name is Jennifer Von Pullman and I'm the Director of Content and PR here at ATTOM. So I'm pleased to introduce today's speakers who will be guiding us through this webinar. We have Todd Teta, Chief Product and Technology Officer for ATTOM, and Mike Simonsen, Founder and CEO at Altos Research. So now here's a brief overview of items that will be discussed in today's webinar. We will give you a quick introduction about who is ATTOM, as well as the various data products and solutions that ATTOM offers, before, of course, diving into what you all came for, which is where we'll be looking at the supply and demand signals for the market's trajectory this winter and talk about what is to be expected when it comes to inventory and prices. Now, please feel free to submit your questions throughout the presentation through the question box, and we will make sure to answer as many as we can at the end of this webinar. And for those that we're unable to address, we will definitely make sure to get back to you within 2 business days. Also, a reminder, you will be receiving a copy of this webinar the following business day. So now, ATTOM, we are your one-stop shop for premium property data with flexible delivery solutions. Our mission is to power real estate transparency and to fuel innovation across various industries with the most comprehensive property data. Now here you can see a better picture of all the various data products that ATTOM offers. This is our ATTOM table of data elements, and it shows how we organize our data into 10 main categories. You see property and ownership, which tracks a lot of information about individual properties, and the data within these categories, as well as our transaction data, provides our customers with much of the core data assets for their business. And then transaction and mortgage, foreclosures, which you're very familiar with, valuation, it captures all of the data that provides value and valuation insights of a property. And then school, hazards, and neighborhood. These 3 categories capture relevant lifestyle data about the community where a property is located, and then boundary data, and of course, listings. Now, we offer a variety of data solutions to meet your business needs. ATTOM Cloud is our newest delivery solution, but we also offer a variety of other data solutions to meet your business needs. For instance, the ATTOM API, through which much of our analytics-ready data can be delivered, such as bulk data, licensing, market trend reports, and more. We also offer real estate marketing lists through ATTOM List, match and append services, and we can mix and match any of our data and solutions to meet your needs. So our data is not one size fits all. Our flexible delivery options give you a choice when it comes to how you consume the data and also how much data you wish to consume. So we tailor our solutions to meet the challenges and opportunities in your industry and for your specific objectives. Now with that, I would like to pass it over to Todd Teta to lead off the discussion.
Thanks, Jen. So many of you joined us for our mid-year housing outlook that we did in May. And like most of our outlooks, I gave some updates, year-to-date updates on typical housing metrics, loan volumes, mortgage rates, sales prices, etc. And we had invited Mike from Altos to focus on the here and now of the market. Mike pointed out what he thought the rest of the year would look like, focusing mostly on the severe inventory issue we had at the time. So it's been about 6 months since then, and we thought it made sense to share what we've seen in the market happen since then. And most importantly, we wanted to talk about what we see happening in the real estate market over the coming winter and into the spring. We like bringing Mike back because I think he has the most real-time view on current market conditions. We've worked with him for years. Altos is a company that focuses on the for sale and for rent markets, works with a lot of players that we also work with in the hedge fund space, investors, agents, brokerages, etc. And they look to Mike and his team for what's going on in real time, and frankly, so do I. So I'm not going to give updates on all of our typical outlook areas, so we have some more time to talk about the winter forecast itself. We'll likely cover those in an end-of-year look or potentially for next year's outlook webinar that we'll do. But I did want to frame this forecast around 2 topics that I think are on top of everybody's minds right now. affordability and foreclosures before we jump into those forecasts. And so let's start on affordability. We recently released our Q3 affordability report that looks at housing affordability across the nation. And this chart particularly compares median home prices with housing costs and wages. The line on the chart is the percentage of the average national wage that goes towards housing costs. We include mortgage payments, insurance, property taxes in those costs, and then we do that math at every county in the United States. So we're capturing local prices with local taxes and local wages. And then we roll that up into a national picture that you see here. The bar is the median national home price. So beyond wages, this is a second input that goes into affordability because it determines how much of a loan someone is going to have to get a home. The last input is mortgage rates, but I've kept that off intentionally because frankly, they've been flat most of this year and aren't really a part of the affordability conversation today. That'll change in a second when I talk about the future. So the reason we contrast price and affordability is so you can see what's happened in the past few quarters. It's a little difficult to see on the chart, but that last few quarters you see there, you see a uptick in that line. That's affordability going down. So line going up means percentage of cost for housing is going up, which means affordability is less. And it's probably obvious by looking at the chart what's driving that. Like I said, mortgage rates have been mostly flat for the year. And though wages have been improving, they aren't improving as quickly as home prices are increasing. Based on our report, we see about an 18% year-over-year increase on a national basis. And I don't know about you guys, I don't know a lot of people that have gotten an 18% raise in the last year. Now, some of you have probably heard about the great resignation or the great reshuffle, where just frankly, a lot of people are changing jobs. And while we're seeing wages are inflating because of that or coming from that, it's definitely not causing an 18% across the board increase for the average person trying to buy a home and staying in their same job. And the picture on affordability is probably worse than I'm painting here, given inflation and other housing related costs that this study didn't measure. Things like utility rates, gas and electricity going up, material costs. You all heard the anecdotal evidence of the $100 piece of plywood, and construction labor, where it's hard to get somebody to come out and fix your sink or paint your house. So with all of those going up too, housing continues to take an even larger chunk of the average person's earnings just to make ends meet. So that said, the average affordability that we came with in Q3 was 25%. So again, meaning 25% of an average wage goes towards housing. And we'd start calling a market unaffordable, just generally speaking, when those costs reach 28%. So if you look at the last 3 months going from around 20 or just shy of 20% up to 25, it's a pretty significant increase in just 3 quarters. And at 28%, mortgages start to become more difficult to get, brings a lot of friction into the market. And so while affordability has definitely gotten worse this year, frankly, a lot worse, mortgage rates are still helping to keep things affordable. And that's where they come back into the conversation. So if mortgage rates increase dramatically, then we'd likely move into an unaffordable territory in a lot of markets. Almost all of the markets that we track, we think that would be a trigger. A significant increase in rates would be a trigger to move all of those past that 28% threshold where they become unaffordable. Though that said, we're not expecting that to happen in the short term or certainly over the winter, though we're keeping our eyes on rates and wage growth as something that could tip the scale on affordability pretty quickly. So the second topic that's getting a bit more interest in the past few months is foreclosures, and I wanted to cover that briefly. To remind everybody, before COVID hit, and we've talked about this on the last couple of webinars, we had expected 2020 to be flat relative to 2019 in terms of foreclosures, just raw counts of foreclosures. In 2019, we had 500,000 total filings, just under. And on previous webinars, we also talked a lot about how forbearance programs and foreclosure moratoria essentially paused foreclosure activity in the residential markets, at least. And these charts bear that out. You can see just a huge drop off when COVID started. Mike's going to talk about forbearance and how it plays into the larger conversation around inventory just in a bit here. But what we do is we look at foreclosure starts, and that's the top chart, represents all new foreclosures. So think of a home just entering the foreclosure process. And then total filings, which is the bottom chart and represents all foreclosure activity as a property goes or a loan goes through the foreclosure process. And as you can see from the last 18 months on both charts, the numbers for both have been close to zero, frankly. But what happened at the end of July was the federal foreclosure moratorium ended. It was lifted. And this started to open up foreclosure activity. Since we track foreclosure filings on a daily basis, we saw an uptick immediately. And it strengthened through August and September as many mortgage servicers brought their foreclosure processing back online. They'd been largely dormant and understaffed during that period. So the net result was that Q3 had the highest number of foreclosure starts and filings since COVID began. Since these are based on historically low numbers, I've blown up the charts on the next slide, so you can actually see the uptick on the last bar for Q3. Otherwise, you wouldn't be able to actually see that uptick. Depending on how you look at it, the numbers are up anywhere from 25 to 35% quarter over quarter, so from Q2 to Q3. And that's with just 2 months active in Q3, that August and September timeframe I was talking about. So we really attribute this to a slow restart of foreclosure processing, and we really don't expect this picture to play itself out until next year. As we go into the holidays and into the new year, we'll start to see what this is really going to look like. That said, we continue to believe we'll see levels of foreclosure like 2015 through 2017, somewhere in that range, from traditional factors that come out of a recession, any recession, unemployment, divorce, death, etc. There are a ton of loans that could go bad and borrowers get into distress, and I've noted some of those categories on the right side of the slide. Those counts, the 250,000 loans in foreclosure before COVID started, about 1.5 million still in forbearance, etc. All in, these three categories represent around 2 million loans, just north of 2 million loans. So those are our population that you might consider at-risk loans. And of course, a majority of these, frankly, a large majority of these won't become foreclosures. And 2015 through 2017 weren't exactly huge foreclosure years anyways. But if we make some rough assumptions about this large number of loans using historical foreclosure rates, it's easy to see us getting back to several 100,000 loans in some stage of foreclosure over the coming year. We also believe, and this is the silver lining in all of this, is that if a borrower does get into trouble with their mortgage, they'll be able to sell their home. Mike's going to go deeper on this, but there's two macro drivers of it. One, that 18% year-on-year increase I talked about sure put a lot of homeowners in a good equity position, a lot more than were in a good equity position prior to the last year of price increases. And not to mention the lack of inventory and huge amount of demand, again, things that Mike's going to talk about in just a second, real time, should mean that any homeowner that does get into stress should be able to put their home on the market and sell it before the foreclosure actually happens. So in short, we expect a lot more foreclosures. We just don't think it's going to move the market like it did in the last foreclosure crisis. It's not going to become a glut of inventory. In fact, it might alleviate a bit of the demand, but certainly won't cause the same type of broad market issues we saw in the last one. So with that, I'm going to turn it over to Mike to take us deeper into the market conditions today and what he sees for the rest of the year through the winter and into the spring. Mike?
All right. Thanks, Todd. So at Altos Research, we track every home for sale in the country, all the pricing, all the changes in pricing, and then we do that analytics every week, and we bubble up for our clients and colleagues to see what's happening right now. What's fascinating is Todd talked about an 18% annual price appreciation. The Case-Shiller index was released this week, and it's actually the August Case-Shiller number, which is calculated from transactions that took place in June, July, and August. And so that was a 19.8% increase. And what's fascinating is that June, July, and August, those transactions had year ago comparison to the beginning of the pandemic, and so they actually were outsized gains. You can see the big spike here earlier in the year in the dark, the top line here, the very top of the dark line. And as the year has moderated, that the baseline comparison has moderated a little bit. Last year was a very strong year overall, and so this year, what we're really looking like is that we will finish the year in a 11-12%, low teens rather than high teens annual home price gain. So the median price of a single family home in the US this week is $389,700. It's 11%, a little over 11.5% over last year at this time. And the way to think about this number is homes are on the market now. They get an offer in November. It closes in December, and then the traditional ways of looking at that data start reporting that in January, February, March. So the Case-Shiller index that will be reflecting in like January, February, and March for what we can see right now in this data. And that's how to view this data here. So what you'll see is that it's moderated a little bit. 11%, 12% is still massive annual gains, trillions of dollars in equity. And it's why, as Todd mentioned, the actual risk of foreclosures is really low. Like, we're coming out of the crisis with 2 years of 11 to 12, 13% home price gains. Everybody in the country has equity. And so even if you get into a situation where you can't pay your mortgage, you still don't go into foreclosure because you're not upside down on the mortgage. So what we can see now is how this is set up for transactions that will happen towards the end of the year and that then get reported the beginning of next year. The light colored line on here is a leading indicator, and it's a really powerful wisdom of the crowds. It's the price of the newly listed cohort, the price of the properties that come to market each week. What happens with this number is that the sellers and the listing agents use their wisdom. That they know exactly where the demand is. They know that the house down the street is still getting multiple offers, and they know that they have buyers lined up, or they know that that's starting to lessen a little bit. And if that's starting to lessen, they price their new listing down a little bit. And so the newly listed properties that come to market, you can see each year it peaks before the market as a whole, and it turns down and troughs before the rest of the market. The light line peaks earlier and troughs earlier. So it's a leading indicator for the market as a whole. And what it's showing us is that most of this summer we had a little bit of a correction, but then prices have been staying strong well into the fall. That's because buyers are buying homes, supporting the list prices well later in the year. Last year was super strong, and you can see how the plateau lasted well into the end of the last year. And in previous years, 2019, 2018, you can see how the new listings peak at the end of June. The strongest market is second quarter, and then you start worrying about school season, so the next homes that get listed come at a little lower. But because homes have been moving so quickly, the sellers know that they don't have to take that discount yet. They can price, as long as they're priced well, it's going to move. So what this is telling us is it's a sign that that demand is staying elevated, prices are staying supported well into the year. And it's a different view from the headlines that you may be getting in other places this week, especially this week, where like the Case-Shiller Index is announcing 19% price gains, but still using data from June, which was way back here. And what we can see right now is that we're going to finish the year in that low teen spot, super strong. As we look at the supply side of the equation, the big trends over the last few years with available inventory of single family homes is each year we have fewer and fewer homes available on the resale market. What's been happening over the last decade is, as mortgage rates have been very low, Americans have been taking enormous numbers of existing single family homes and converting them into investment rental properties, and therefore not selling them. So they go to buy the next place and they don't sell the first place. So as rates are low, it becomes very affordable to own two of those. And you can see the peak of each year slightly lower than the previous year. 2020 was craziness. And two things happened. One, we did all of our pandemic nesting, but also rates plummeted even record lows. So it happened all year. They gobbled up quickly. And even when I'm buying the next place, I'm not selling the first one. And so the low rates have an impact of having not only an impact on demand, but actually has an impact on supply. You can see in here the one time in the last, this is a 7-year chart, 6 or 7 year chart. The one time when we had more inventory, we started the year with a greater inventory year over year, was this January 2019. And what had happened was during 2018, from April to December, mortgage rates rose. They rose from about 3.8 to 4.8%. And this is how you can see what consumers recognize. This was that affordability metric that Todd was talking about. So as it's less affordable to hold two mortgages, now I sell more. Now I list my first property. And so we ended 2018 with slightly more. We started 2019 with slightly more inventory than 2018. After that point, though, rates started falling again, 2020, 21, and then we've been at ultra low rates ever since. So what we're looking at here is we're now, as of this week, there are 423,000 single family homes available unsold on the market. It's record low. It's about a third lower than last year at this time, 20-some% lower than last year at this time. And you can see where the trough hit. We are about 6 weeks past the peak for the year, and each week inventory is ticking down, as you'd expect for October. The thing that we're watching on this number each week right now is October brings really the end of the mortgage forbearance process for the vast majority of the people still in it. Originally, there were 6 or 7 million people in the mortgage forbearance. There's still a little over 1 million left, and most of those are finishing in October. So the question is, if I haven't been paying my mortgage for a year or 18 months, and now I have to, if I can't afford that mortgage, what am I going to do? The fear is that those properties are going to get listed. They're going to get listed in bulk, and all of a sudden we're going to have more supply, and that's going to drive down prices. That's the fear. So what we're looking for is that happening? And it turns out that it is essentially zero of those properties that are coming out of forbearance are getting listed for sale. Like essentially zero, undetectable amounts. And that the reason is because rates are super low. I've gained massive amounts of equity. Even if I haven't paid my mortgage for a year, my home has gained more equity than I added in debt to the loan by not paying. So I'm in a better position financially. And so everybody coming out of the mortgage forbearance process is figuring out how to stay in their home. How do I keep this home? And so each week we're looking at this number. Now, if we see, for example, an unseasonal uptick in inventory in November, we'll know exactly where that's coming from. But as of right now, we've seen essentially zero. This also bodes well for the foreclosure equation that Todd was talking about. If they're coming out of forbearance and they're paying and they're staying in their loan, they've got extra equity and their rates are really good. Like, these are good deals that people are holding on to. They're not upside down in a lousy mortgage with an exploding rate like the last time around. So, our view is that because the American homeowner is in such a strong position, as soon as we work through some of the backlog of the normal foreclosures, like, we could end up in the next few months in a position where we are in record few homes anywhere in the foreclosure process, because even the normal foreclosures that would happen would be because I've got to sell my home quickly and I don't have any equity. But if I have had my home for any amount of time, I've got equity. So even the normal levels of foreclosures are fewer right now. So that's the supply side. Let's look at the demand side. We use at Altos a metric that we've been tracking all year called immediate sales. The phenomenon that's been happening is homes are getting listed and they're taking offers and going into contract within hours or a couple of days of listing. They may be bidding wars, or they may be just getting even just one offer, but it's happening immediately after listing. And so it has the effect of actually making our active inventory look lower, because those homes they're not available anymore. They're already sold. And so this week, 22,500 immediate sales of about 90,000 properties that got listed this week. 22,000 of them went into contract essentially immediately. That as a percentage, 25% or so, has not been decreasing as we go later in the year. That's showing demand is keeping up. One phenomenon anecdotally we hear is that there are fewer bidding wars. So in the peak of our frenzy this year was April and May. And at that time it was 20 multiple offers and 25% overbid. And what we're seeing now is maybe multiple offers are, maybe it's 4, or maybe it's just one offer, but it's still happening immediately. So fewer multiple offers, slightly less competitive as it's later in the year, but still plenty of them to go immediately. And one of the things we've noticed is that many of the people who are buying now are those who lost their bidding wars in May and June. Now they're saying, aha, I don't have to compete as hard right now, but I still want to get my home. I'm still anxious to get my home. I've been trying to do this for 8 months. And so that's why we see the immediate sales still staying strong. What this also tells us is on the foreclosure process, one of the reasons that I would go into foreclosure, so I'm upside down on my mortgage, I can't afford it, and I look at my neighbor and I say, my neighbor is taking 6 months to unload his house. That's when I say, I got to walk away. I'm not going to get out of this thing. What's interesting is I can look at my neighbor and I see my neighbor sold his house in 7 days. I have equity. And even if I can't get, I'm never going to be able to pay my mortgage again. Let's say I went from 2 incomes to 1 income this year in a permanent sense, and I have to sell my home. I can do it in a week or up to 3 weeks now, but it's still before I have to make the next mortgage payment. Like it's still remarkably strong. And so this demand curve is one of the signals that allows us to say it's a few things. One, we're set up for a strong price appreciation spring already because we can see the demand there. And 2, that pipeline of foreclosures, we are not at all bearish about foreclosures coming out of the forbearance process. And in fact, like I said, I think, we're likely to see record few on the foreclosure side. On the other side, the other indicator of demand we like to use is the percentage of homes on the market with price reductions. And this is a really powerful leading indicator for where transaction prices will be in the future. And you can think about it this way. You can see a very tight band of around a third of homes take a price cut nationally. Around a third take a price cut before they sell. Sometimes that is strategic. Sometimes it's accidental. Sometimes it's an aggressive seller who wants to try to see if the market will bite. And so, but it's about a third or 35%. In hot markets, now a third are overpriced, but there's enough bidders, enough demand that only 25% had to take a price cut. When the market cools, it's now maybe 38, 40, 45%, or half of the stock has taken a price cut. That really tells us that they are taking a price cut now. Therefore, in the future, the transactions are going to be taking place at a lower price. So what we're seeing now, and you can see the cycle very clearly, our pandemic cycle completely broke the normal seasonality as demand kicked way high late into the year. So normally 37% of homes would take a price cut. Right now, last year it was 26%. And then this spring in the frenzy, it was down to 16%. Only 16% of all the homes in the US had to take a price cut. Even the ones who thought they were way overpriced were getting what they were asking. That's how strong the demand was. Market cooled significantly this year, but cooled to merely hot. Right? It's like you're going down the highway at 100 miles an hour and you take your foot off the gas, you're slowing, but you're still going really, really fast. So both of those things are true at the same time. And that's what this is showing you here. We've also passed our peak of price reduction. So now as we go into the fall, there's fewer homes, there's fewer new listings that will get pulled off the market if they didn't sell to get relisted in January. So this number is going to reset in a lower position. Not quite as low as last year, but it's going to reset down here in the 20s next spring. What that tells us, again, is we're set up for strong price appreciation for the spring. And the spring is where the bulk of home price appreciation happens for the year. So you can already see that it's going to be like an 8% price appreciation range for 2022, barring some change. And that change could be rising interest rates. This will also show you can see the period in 2018 where we went from the low point in price reductions to the high point in this chart in that one summer season. To that 37.2 is at peak right before rates started falling again. So you can see the impact, and basically this is exactly how the market cooled. We can see demand back off precisely. So what we were looking for this fall was the price reductions going to get back in the 30s? Is it going to look more normal, or is it going to turn the corner and start to be to stay in this hot range? And it has turned the corner. It's like 3 weeks in a row we've ticked down in price reductions. So what that says to us is that we're setting up for a strong spring, and we can see that in the it's one of the aspects of affordability. Now rates they're above 3% for the first time. And do they go to, when they go to 3.5%? Is that when the consumers feel it? In 2018, it was when they went from 3.8 to 4.8, the consumers felt it. Is 4 the range? Our long-term decade-long average is 4%, just under 4% for the 30-year fix. So as we get close to or above 4%, is that where the consumers now start feeling that mortgages are expensive and they start feeling the affordability pinch? That's unclear to me. We can't see it in the data yet because we've been so cheap for so long. But that's what we're looking for. And when it starts rising, if you want to, for example, test your hypothesis that the market's cooling, you can watch this price reductions number each week to see how much the consumer is feeling it. And then lastly, as we go into any kind of opportunity for changing market, we like to, at Altos, we look at every market in the country in 4 price range quartiles. The high end of the market may be behaving very differently from the low end. Over the last 18 months, every price point in the whole country has had big demand, moving very quickly. And what you can see here is I have the days on market highlighted for the 4 price range segments across the US. The low end of the market being about 150K and the high end of the market being about $1 million. You can see that 300, 350 range is where the fastest days on market, and that's the biggest consumer demand. That's also where the biggest institutional price points are, the buyers for single family rentals, et cetera. It's right there just under the median price in across the country. And you can see that that's where the fastest days on market is. If, for example, the market starts slowing or rates spiking, you'll see the days on market at the high end will tick up faster. So you could see a signal in the high end of the market before you see it elsewhere. It's also important, like when you're thinking about your price box, how does that work? That price box in Phoenix is a different quartile than it is in San Jose. And so you can compare to the market, relative to the market around it. Okay, so that's what the world is looking like right now. It's the signals for where we are set up for the end of the year already, and for how the first quarter is already. You can see the demand there, and we can see that we're going to reset in supply. We're going to start the year at record low with plenty of demand. So it's going to be a strong year. We're already set up for a strong 2022, and we can see it in the data already. We get to this point in the conversation, and people are usually asking me, like, Mike, can we look at my local market? Can we dive in and look at this part of the world? This is where we're buying. The answer is yes, we can look at your local market. The best way to do that is to go to altosresearch.com, connect with us, book time with our team. We'll dive into the local market, and we can do local view and how you're going to communicate or do your analysis for the places where you have exposure to. And with that, I'll hand it back to Todd.
Thank you. I'm going to take it over from you, Todd. Thank you guys both so much. And I just want to take a few minutes now to answer some questions that have come through. And again, like I mentioned, if we're unable to get to your questions, we will definitely get them answered to you within 2 business days. So now the first question I have, I think Mike will be geared towards you. It says, what big changes would need to happen to change this low inventory environment?
Okay, yeah, that's a great question. So we will start the year with record low inventory. We'll start it with fewer homes available than we started this year, which was already record low. Probably about 300,000, only 300,000 single family homes in a time, when very recently there would have been 1 million homes on the market. And as I mentioned, it's been decreasing every year for a decade. As money's been cheap, it's been really cheap to own investment properties for rental. And we've converted 8 million or so. Most of that conversion is happening by individual investors who own 1 to 4 properties. Some of that's big institutional players. But you can see that inventory climbed a little bit when rates went from 3.8 to 4.8. So you can imagine that we need a world where rates go from 3 to over 4 to or higher for several years for inventory to build up. All of the existing stock, everybody in the country now has a really cheap mortgage, and they have that forever. So they won't ever really be forced to sell those properties. So it really seems like multiple years of higher rates before we shift back into anywhere near our former trading range of having a million or so homes on the market. That's the big factor. The other factor is construction. We're finally starting to build more homes, and now we're running into supply chain problems, but we underbuilt for a decade. So we are behind in new construction. So that'll start to add to that as well, to start to change that equation. But really, we're looking at a multiple years cycle of this ultra low, a new trading range.
Okay, and I think that kind of goes into this next question. Or, should sellers list their home in November or wait until January?
So let's see. I'm not a realtor, but what I would tell you is this: from the perspective of the data, we know that there is actually an unseasonal strength in demand right now, and homes are moving significantly faster than normal Novembers. So if you are, if you were in a place where you're debating, you're like, wow, I really need to unload my house, but it's really not a good idea to sell in November. This November is significantly better to sell than most Novembers. On the other hand, we also can see that there's plenty of pent-up demand for January, right? It's already there. The buyers are already there. And the only risk for January is, do mortgage rates spike between now and then? And that would be an unknown. And all of a sudden you have lesser demand. They're not going to spike. You're not going to, go to 6% or something like that. So it might just be a little bit cooler for waiting for January. Your risk isn't super huge, but that's the unknown in the next, 3, 6, 12 months is where do mortgage rates go, and really how sensitive are buyers.
Okay, now Todd, for this question, how will inflation impact the real estate market next year?
Sure. Yeah, we've been talking a lot about this throughout the conversation, right? With Mike describing housing costs or material cost inflation. I talked about that a little bit. I think it's particularly in the news lately because of some comments that have come out recently around hyperinflation and either the truths or fallacies of that, depending on which side of the coin you end up on. But just as far as it impacting the actual real estate market, it's clear that it's impacting labor and material costs, which goes right to anybody that's doing investment, investor work, home builders. So you're starting and continuing to see increased prices for those folks, which just trickles down to the consumer in the form of higher home prices. It's buried in that anywhere from 11 to 18% price appreciation that we've been talking about. It's a portion of that, but it's certainly an impact in it, in there somewhere. We don't have necessarily a view on what the inflation amount might be, say a consumer price index view of the world, but we do know that housing costs are going up, hitting affordability, and prices are just raising further and further, exacerbating the issues we've been talking about. So, as far as hyperinflation, we'll hold off on pontificating on that. We're not economists. Mike said he's not a realtor. I'm not an economist. I'll leave that to them. But I think the general sense is inflation as a whole will impact the real estate market, in a negative way next year.
Awesome. Okay, now we have this last question. I think could be geared towards both of you. Now Zillow said they're stopping their iBuying for now. What does that mean for the market?
Zillow caused some waves this week, getting with some news saying that they stopped their iBuying, and consumers and people in the industry are looking to say, is that a signal? Does Zillow know something that we don't know? Is there a market crash coming? Or have they been overpaying for properties? So as far as we can tell, like the Zillow, the iBuying business is a big investment business. They're putting billions of dollars into it, and so there's no like market crash signal about them stopping buying, because like we can see the demand, we can see that because inventory is tight and demand's high, that they want to, for example, compete less for some of the tough properties, and like that maybe factoring into it. My other suspicion is that it's probably a function of it's taking longer to remodel homes because of the supply chain problem, and therefore they're holding on to the properties longer than they initially expected. So they are extending their pipeline. We don't see it as any kind of crazy early indicator of a smart player getting out soon. What do you think, Todd?
Yeah, I mean, there's probably two factors I'd add to that. One is the iBuyers as a whole. We don't view them as market makers where they have, say, a majority or even a large minority share of any particular market. It's still a small percentage overall of the demand that's out there. So, frankly, there's plenty of buyers that are happy in sharing that they don't have to compete with one more buyer in a particular market. So that's the first point, is they aren't making the markets per se. The other thing I'd say is we work with a lot of investors, a lot of flippers of homes, and it's not uncommon for them to be seasonal in their purchase activity. And so on one level, you might say Zillow is just being a rational buyer, and an irrational buyer of homes, not wanting to take things to market in the December, January, February, March timeframe. You talked about that lag from purchase listing to sale. They're exposed to that when they buy as an iBuyer. So on one level, you could think of them as another rational market player. Either way, we largely agree. It's not a signal of something that we should be worried about. More broadly, the other iBuyers, large player iBuyers, are still quite active, expanding into new markets. The business model has seemed to have proven itself through COVID. I think there's some questions as a business model, how they adjust to changing markets. And it'll be great to see how that comes out. I think, largely here to stay, the big players, largely here to stay with consolidation of some of the small local market folks that are doing it, and not something that we should read too much into with their announcement.
Well, thank you again, both, for joining us and giving us your insights. And thank you so much to everyone for attending. Please visit our website at attomdata.com for more information on ATTOM and to keep up to date on the housing market, as well as current climate of the market. Also a reminder, this webinar was recorded and will be emailed to you the following business day. Thank you all so much.